Hello and welcome your tune into this Mutual Fund Corner YouTube edition episode. And joining me today is Jitendra Agarwal, who is the founder at Kukku Capital. He's here to tell us how can one analyze their portfolio and form a portfolio which gives balanced returns and has a balanced exposure to different classes as well. Mr. Agarwal, thank you so much for joining in. Well, the most basic thing is how do you start creating a balanced portfolio? What are the asset classes you can have an exposure to? So can you first tell us what are the categorization of different equity mutual funds that an investor should be aware of?
Sure. Thank you so much. Hello, everyone, and thanks to CNBC-TV18 for inviting me to this special discussion. Our focus is to guide investors, especially HNI and super HNI investors, on how to create a good equity mutual fund portfolio that generate risk-adjusted alpha. The goal is to outperform comparable products like PMS or AIF while keeping risk and cost at lower point. Let's start with the basics. Understanding equity categories. There are about 6,000 listed equity shares on the BSE portal, and out of these, 3,000 are listed on NSE portal. But equity shares are broadly categorized by market capitalization, which includes large. First 100 listed equity shares are large cap, then 101 to 250 are mid cap, and then 250 to 500 are small cap. Remaining are called as micro cap or penny stocks. Understanding this classification helps to understand how equity mutual funds are structured and how the fund managers select the stock from the broad basket. You will be surprised that only first 500 listed equity shares according to market cap are mostly being selected by the fund managers to allocate their portfolio in equity mutual fund schemes. Hence, this is the first filter where market risk of liquidity, volatility lowered as compared to direct equity investments. Equity mutual funds are generally grouped in three categories, which includes by market cap exposure, we can say large cap, mid cap, small cap, flexi cap, multi cap. Second category by strategy or style, like focused, value funds, contra funds, dividend yield funds. And third category by sectorial or thematical allocation, which includes IT funds, banking funds, pharma funds, infrastructure fund, consumption, FMCG, ESG, innovation, and many more. So this is the mutual fund categorization by broadly defined by SEBI.
Got it.
Now, we aim to create a well-balanced portfolio with a scheme across multiple categories. The typical allocation for an HNI portfolio may look like this. 45 to 55% of allocation will go to core schemes. Core scheme means flexi cap, multi cap, focused, value funds, dividend yield funds. And next, 20 to 25% allocation will go to mid and small cap category of schemes. And rest 15 to 20% of allocation will go to tactical like sectorial or thematic funds. After this, you will be surprised to see that final outcome, in spite of we have not considered any pure large cap fund, the allocation will give us roughly 50 to 60% allocation to large cap stocks, 20 to 25% in mid cap, and 20 to 25% in small cap. Rest may be cash or micro cap funds.
Well, that makes sense. But now that we know the categorization, what are the different ways in which you can build ideal scheme portfolio by selecting, say, different schemes in different categories? And how can one go about it if they are just starting out as a fresh investor?
Yes, I am going to that point as well. If we see the first 50 to 60% of portfolio, we have seen that typically includes large cap equity shares, plays a key role in reducing overall risk. These large cap stocks generally mirror the market benchmark performance, so they provide stable and predictable returns. However, the remaining 40 to 50% allocation is spread across mid cap, small cap stocks is where the real alpha generation happens. So first 50 to 60% allocation, where we had considered that allocation for lowering the risk, and rest 40 to 50% allocation we focused for real alpha generations. So first we talk about how to create the core of an equity mutual fund portfolio. The goal is to ensure stability, consistency, and scope for alpha generation. The key factors we consider while selecting core funds, which usually comprise about 50 to 60% of total portfolio. First, we see the fund management strength. We start with the experience of the fund manager and their support team, their track record, investment philosophy, and ability to navigate different market cycles matters a lot. We see the scheme's current portfolio allocation. We carefully review the current portfolio of each scheme. This helps us understand which sectors or stocks they are overweight or underweight.
Got it.
Avoid excess overlapping of stocks. We see the standard deviation of the schemes, because in a high standard deviation means high volatility is there.
So how does one assess the level of risk with the kind of returns they're going to get? Because there are different categories of risk, there are different categories of returns associated with the risk that one can take as well.
Ideal number of schemes, mainly if we see scheme count should depend on portfolio size, risk profile, fund overlap. We have to see fund overlapping and category diversification. More schemes, that does not mean more diversification. We have to check holding overlapping, focus on quality of allocation rather than quantity of funds. The most important thing is to analyze where 60-70% of the portfolio value is concentrated, and that's the portfolio where the alpha is coming or lacking. So in my view, if we go for core funds, flexi cap, multi cap, focused value funds, there may be 3 to 5 schemes. For mid and small categories, there may be 3 to 4 schemes. For thematical and sectoral fund, there may be 2 to 4 schemes. So overall, ranging of portfolio size, risk profile, the number of counts for schemes ranging between 8 to 12.
Mr. Agarwal, thank you so much for joining in today with your thoughts and telling us how one can go about investing and creating a balanced mutual fund portfolio, especially if they are a first-time investor.